Hello there. I hope that you are doing well. Welcome to this new lecture of the 2025 model series. This lecture is going to be on times of interest. Before we begin with this lecture, I just want to apologize if the audio may sound a bit different than usual, and the reason why is because I'm currently traveling and I'm right now recording this lecture whilst being on the airport. I, however, didn't want to delay the release of this lecture, and therefore I'm just going to record it now. When it comes to times of interest, it's very important to understand the following. Times of interest allow you to know exactly when you are looking for specific algorithmic signatures and a derivative price. This removes the hurdle of having to sit behind the charts all day through bad price action. Meaning, when we come to the charts, we must understand when we are looking for specific algorithmic signatures within the delivery price. That is what I will show to you during this lecture. First of all, you must understand that there are different methods of defining times of interest. First of all, we are looking at the concept of SMT. The reason why we're looking at SMT is because SMT is a crucial element when it comes to timing key market reversals. Next step, we're going to be paying attention to macros. And thirdly, we're going to be paying attention to delivery profiles. It's important to understand, however, that we haven't discussed the topics of SMT or delivery profiles yet within this model series, and therefore I'm going to create separate topical lectures on these topics as well. But for now, we're simply going to focus on the basics when it comes to SMT and delivery profiles. First of all, let's take a look at the concept of SMT. On the left right here, you can see a schematic where you can see two markets which are highly correlated. You can see that both markets are creating a reversal. However, when we're paying attention to this reversal, I would like you to see that the first market creates a lower low, whilst the second market creates a higher low. When we see this right here, whilst we are anticipating higher prices because the higher time from institutional order flow is bullish, we're expecting the market to draw towards an objective above market price. We can anticipate that when we see this sign become present, that we're likely seeing that key reversal taking place. On the right here, you can see the opposing scenario where you can see that there are two highly correlated markets, and we see a swing high formation. Where I can see that market one takes out the previous swing high, whilst the other market doesn't. And that right there is S&P, which is present on the highs. We look for S&P when we're in a bearish market environment and we are anticipating the market to drop towards the price objective below market price and we have reached a higher time frame POI. It's important to note that both forms of SMT are exactly the same but simply inversed. What I would like you to understand is that what you can see right here is that I've plotted boxes on the final fractals before the expansion took place. What I would like you to understand is that it's inside of this run lower, followed by that expansion higher, that a lower time frame market maker bimodal is present. The same is, of course, taking place on the opposing side, where we're seeing a market make a sell model inside that final run higher, followed by that expansion towards the downside. It's very important to understand that by seeing this SMT on a bigger time cycle, we can anticipate that on the lower time frames, we're likely seeing these market maker model fractals playing out. When we pay attention to a chart example then, what I would like you to see is that on the left you can see the Nasdaq and on the right you can see ES. What I would like you to see is that the Nasdaq initially consolidated and then we saw the market expand towards the upside. Notice that the market was drawn towards previous day high, which is right here, and notice that the market did not take out this high. Instead, we created relatively equal highs. If we pay attention to the right then on ES, what I would like you to see is that ES also consolidated and we saw ES expand towards the upside. Notice, however, that when this expansion occurred, ES took out the previous day high, whilst NQ didn't, and that right there is SMT relative to the previous day high. What I would like you to see then is the following. As you can see, I've put a red box around this delivery. And what is important to note is that when you pay attention to this delivery, you can see that this run up higher is the buy side of the curve, and the run lower which follows is the sell side of the curve within a market maker sell model. Buy side to sell side. When you start to understand that this S&P is literally signaling to you that we're forming that swing high, you must then begin looking at the lower time frame factors to in fact confirm that reversal taking place. We're now going to be paying attention to a bullish scenario, and what I would like you to see is that on the left you can see Nasdaq again, and on the right you can see ES. What you can see on the left is that Nasdaq expanded towards the downside and the market was drawn towards this daily low of the Tuesday low. Notice the market reached this objective, took it out, and then reversed. If we pay attention to ES, however, what you can see is that ES also expanded towards the downside, drawing towards the Tuesday low, But notice that ES did not take out that row, and instead ES created a high low. I know these rows seem relatively equal, but Nasdaq took out the low whilst ES didn't. And therefore, that is S&P which is present on the rows right there. That S&P signals to us that we're likely going to see the market begin to reverse. What we will then do is we will drop into the lower time frames and confirm to us that we're in fact drawing towards buy side of the grid next, because this is a market buy model where I can see the sell side of the curve followed by the buy side of the curve. Now it's important to note that the reason why I want to touch on S&P as first when it comes to time of interest is because a lot of people seem to believe that macros are the only way that you're able to basically try and time the markets. However, I want you to understand that macros are simply an introduction when it comes to time and its influence on the delivery of price. You must understand that we can utilize S&P to anticipate order flow changing already before it even occurs. And therefore, whenever you see S&P relative to a bigger time cycle, that's your first sign of all right, pay attention now. And that also basically shares with you when you can anticipate a certain macro to deliver in a specific way, which we're going to touch on next. When we pay attention to macros then, what I want you to understand is that between every single hour, it's 45th minute, and the next hour, it's 15th minute, what you can see is that there's a 30-minute interval in which algorithmic signatures, as I'm teaching them to you, will present themselves. When you start investigating these specific time windows, your mouth is going to fall open because it's literally hidden in plain sight that within this specific 30-minute interval, you're going to see the same algorithmic signatures again and again. However, this doesn't mean that I want you to look at the markets all day. I don't want you to do that. It's possible, don't get me wrong. However, you must understand that at the end of the day, your job is to filter out the cleanest opportunities, and you filter out those clean opportunities by looking at delivery profiles, by looking at bigger S&Ps and all of that stuff. And therefore, as a general rule of thumb, these are the macros which I am personally paying attention to. Meaning for the London session, I'm paying attention to the 2:45 to 3:15 a.m. macro. Please note that all these times are in New York time. Next that for the London session, I'm paying attention to the macro from 3:45 a.m. to 4:15 a.m. Then for the morning session, I'm paying attention to the 9:45 to 10:15 a.m. macro. And next that I'm paying attention to the 10:15 to 10:45 a.m. macro. For the afternoon session, then I'm paying attention to the 1:45 to 2:15 p.m. macro. And I also paying attention to the 2:45 to 3:15 p.m. macro. As you can see, for all sessions that I've plotted here between the London to New York afternoon session, I have two macros which I'm paying attention to. Please note that I'm not paying attention to each one of these macros every single day, because I'm not doing that. I'm staying on the hourly chart and we're recognizing, all right, when do I anticipate a swing higher, swing low to form? When I'm able to anticipate when it swing higher, swing low forms, I'm able to then drop into the lower time frames and pay attention to these macros during the sessions to say, okay, this is when I'm going to engage. This is when I'm going to fill my positions, etc. Or this is when I'm anticipating price to behave in a specific manner. And that's the power of these macros. Now, when we pay attention to the Asia session, then I would like you to understand that during Asia, the same time windows apply. However, I want to ask you something. If you know that for the index futures specifically, the London AM and PM session are way cleaner than the Asia session, why would you look at the Asia session? I understand that some of you might be living in a continent where the timings for Asia are simply better, but even then, I would still suggest you to mainly focus on the London AM and PM. And the reason why is because throughout Asia session, you usually do not see a lot of volatility, and therefore, in my opinion, it's not worth looking at. When you pay attention to a chart example then, what I would like to see is that in front of you, you can see a London session delivery. And what you can see is that throughout the other part of the Asia session, the market expanded towards the downside, and then eventually the market from 2:45 to 3:15 a.m. began. Notice that we see the market expand towards the downside, form this row, retrace, and we then have one more push towards the downside. What is this factor right here? Well, the moment that this push lower occurs, you must immediately think to yourself, all right, we might be setting up a bullish breaker formation. Why? Because we form a low, high, lower low, higher high. And therefore, the moment that we see displacement through this high, which formed inside of a CB, that confirms to us, all right, we have likely formed the SMR right here. And when we have formed the SMR, we can anticipate that we're likely going to see the next delivery taking place. When are we likely going to see that next delivery taking place? Or we're likely going to see that next delivery taking place either shortly after the macro, or as you can see right here, time distortion takes place, and then throughout the next macro from 3:45 a.m. to 4:15 a.m., the real delivery takes place. When we pay attention to the next chart example, then what we would like to see is that inside of this chart example, you can see that the reversal occurred outside of our macro window, and therefore, what we're paying attention to is the following rule. Whenever a market reversal occurs outside of the macro window, we pay attention to the following. We pay attention to the next macro to anticipate the expansion to take place. Meaning, what you can see is that at 5:18 a.m., we saw the market reverse right here, and we saw it begin to displace towards the downside. Notice that when this displacement towards the downside occurs, we're immediately thinking to ourselves, okay, let's wait a bit until the next macro window so that we can then anticipate that we're likely going to see the next expansion occur. Meaning, what you see taking place is that displacement lower occurs, and you see that we in fact begin to roll over. Where we initially reprice towards the upside, you see that IPTA begins to displace towards the downside, and we see a sell program unfold. Notice that we form a bearish value gap right here, and the market retraces into that right here. Notice that we see consolidation occur, and eventually the market begins to roll over, drawing towards engineered sells and creating resting below this row. When it comes to delivery like this, it's important to note that whenever an SMR forms outside of a macro window, we pay attention to the next macro window to anticipate when the next expansion is going to take place. Write it down, please. When we pay attention to the New York morning session then, what I'm targeting to see is inside of this chart example, what you can see is that the market was consolidating up here ever from 8:30 a.m. Notice that 9:30 opened up and we saw the market reprice towards the downside heavily. Notice that we saw a quick expansion lower. Then at 9:45 a.m., we saw the first macro of the morning session that we truly pay attention to taking place. This 9:45 to 10:15 a.m. window, guys, man oh man. If you would just focus purely on this macro, you would find all the opportunities which you would ever need to make a living from these markets. What you can see is that at 9:45 a.m., we see a reversal taking place, and we then begin to see the market expand towards the upside. Now, I would like to think about the following. What is present inside of this delivery on the lower time frames? It might seem like we just reprice the lower very quickly and then expand towards the upside very quickly. But on the lower time frames, you must understand that we actually see the signs of a lower time frame market make a buy model taking place. When we pay attention to, for example, the seconds charts or such. When we pay attention to another chart example then, what I would like you to see is that we see the market expand towards the upside, we see the market reprice higher. Notice that we see the market consolidate eventually, and at 10:28 a SMR unfolds, where you begin to see that the market is being repriced towards the downside all of a sudden. You see these big down cross candles? You're probably wondering why is exactly at 10:28 the market turning around. We'll get to that in a bit. What I would like you to see is that the market displaces lower and a retracement occurs. In our minds, we immediately think to ourselves, okay, wait a minute. The macro isn't present yet, and therefore we must wait for the next macro from 10:45 to 11:15 a.m. What we can see is that between 10:45 to 11:15 a.m., the market begins to eventually expand towards the downside and begins to accelerate. Now, when it comes to anticipating expansions, it's very crucial that you understand this rule, which I'm outlining to you now, that whenever the SMR unfolds outside the macro, we pay attention to the upcoming macro to anticipate that there is a security run taking place. So it means if we look to position ourselves short inside the market, it means that we are going to look for that opportunity to present itself throughout that macro window. Notice that the market eventually expands towards the downside and draws towards sales liquidity, resting below this row right here. When it comes to delivery profiles have the following rule. You must focus on recognizing the manipulation cycle. Once you recognize the manipulation cycle, you can anticipate the distribution to follow. Meaning, your job is to recognize manipulation, because once you recognize manipulation, you can anticipate distribution to always follow. And that is one of the most important insights which I would like to share with you. One of the most important lessons which I had to learn the hard way was, instead of just chasing price patterns for the sake of chasing price patterns, such as value gaps or breakers, my job became recognizing delivery profiles. Meaning, my job became literally just focusing on recognizing manipulation, because always after manipulation, we see distribution unfold. That's a general rule of thumb. And therefore, inside that manipulation, we can anticipate to see the signs of an SMR forming. Because once those signs become present, that is when we can anticipate, all right, we're now going to distribute towards the opposing side. Focus on recognizing manipulation, guys, because by focusing on recognizing manipulation, trading the distribution becomes very straightforward. What it looks like within the charts is like the following. When we're looking at a bearish example, we're looking for the market to consolidate. And what's happening inside of this consolidation is that both buy side and sell side are being engineered. We eventually see the market open up for a new time cycle. And we see the market begin to open up and run higher, taking out the high of the consolidation. This right here is the manipulation taking place. The moment that this manipulation takes place, I'm immediately thinking to myself, okay, who is now being trapped into breathing higher price or next? Retail minded traders. And therefore, what I'm looking for is I'm looking for the signs that confirm to me we're rolling over. Because once those signs become present, that's to me confirmed that the manipulation has ended. Then I can anticipate that we're now going to distribute towards the downside. When we pay attention to a bullish example, then what I would like you to see is that the market is consolidating and it's going sideways. Inside this consolidation, both sell side as buy side liquidity are being engineered. We eventually see the market open up for a new time cycle. Throughout this opening, what's taking place is that the market will seek to open up, drop lower, taking out sell side liquidity engineered below the low of the consolidation, and this is manipulation which is taking place. The moment that this manipulation takes place, we can anticipate that distribution will fall afterwards towards the upside. How do we confirm this? By looking at SMT and, for example, macros. Now, I understand that when you're looking at these chart examples, you might be a bit confused and you might be looking at them and you might be like, it can't be that simple, right? It can't be that straightforward. What if I told you it is? What if I told you can literally go into the charts and lose countless nights of sleep over investigating what I'm outlining to you here? Especially when you start blending it with the time cycles logic which I've taught you prior. When we look to blend these three elements to confirm to us that the time is right for the market to behave in a specific manner, we are going to be paying attention to, first of all, SMT to confirm a swing low or swing high formation, because it's inside of that swing formation that a lower time frame market maker model is presenting itself. Next step, we're going to be paying attention to the macros, so that reversal is taking place preferably throughout the macro window. If it doesn't throughout the macro window, we know that we must wait for the next macro window to anticipate that expansion taking place. This does not mean we cannot engage prior to the macro window. However, if you want to enter and immediately see the market expand in your favor, it's best to wait for the macro window. Next step, we're going to be paying attention to delivery profiles in the sense of AMD. We're looking for manipulation because once that manipulation is taking place, we know the distribution will have to follow afterwards, always. When we pay attention to a chart example then, what I would like you to see is that on this chart example, you can see that the market opened up at 1 p.m. right here. We saw the market expand towards the downside. It's inside of this expansion lower, and a lot of retail mind traders are being led to believe that lower prices are next, meaning they're being led to believe that we're going to see the market just continue dropping forever. It's inside of this one lower that manipulation is taking place. What we're now waiting for is we're waiting for the market to show the signs to us that it's in fact turning around. What are we looking for? Well, we're looking for the market to reach a point of interest, and from there, we're going to be looking at the right time. We confirm that the time is right when we're looking at, for example, the macro window right here from 1:45 to 2:15 p.m. What you can see is that the market forms a low during that macro window, and should begin to expand towards the upside. Do you see how it runs up higher? We then see a retracement taking place, and we see a 10-minute cycle SMT become present with the Dow Jones right here. This is being detected by the SMT detector. Notice that the market then expands towards the upside, and we see these big green candles form right here. From this moment in time, when you see this run up higher taking place, you must immediately think to yourself, okay, wait a minute. We have just manipulated towards the downside. We have seen that every retail mind trader is thinking to themselves lower, lower, lower. We have seen a reversal form throughout our macro window. We have seen SMT. Therefore, the BC which forms this discount array right here is a potential longing opportunity. Targeting what? Targeting the current high of this 90-minute cycle with buy side liquidity resting above that high. When we pay attention to a bearish example then, what I would like you to see is that we're back at the same bearish example, and what you can see is that the market opened up at 9:30 right here and initially began consolidating. Notice that it eventually expanded towards the upside, and we saw the market begin shopping around shortly after 10 o'clock. it begins to deliver in a high resistance grid run, where you can see it's just going back and forth, back and forth, back and forth. Whenever the market is consolidating, it's important to note that S&P ends this consolidation, and the reason why is because it's inside of that S&P that is being presented that we are going to see the market eventually begin to roll over. Notice that at 10:28, the reversal unfolds and we will see the market begin to displace towards the downside. From this moment in time, we have two key variables that we're aware of. First of all, we saw 10 o'clock open right here and we saw it run up higher. This is manipulation which is taking place. Next that we have seen S&P unfold between Nasdaq and ES, and therefore that confirms to us, all right, we're likely going to see the market roll over soon. Now we're simply waiting for the 10:45 marker to anticipate the market effect beginning to expand towards the downside. Notice that at 10:45 we see the market retrace into a CB which formed shortly prior, and notice that the market then expanded beautifully towards the downside, drawing towards the downside, creating resting below this low. Why in particular this low? Why not any low prior? Well, this low formed shortly after 9:30, and therefore this was the regular trading hours low up until that point, and therefore that's a key sales liquidity pool to target. Understand that I discussed a lot during this lecture, and it's totally understandable if your heads are spinning right now, because time is one of the most fascinating concepts when it comes to looking at the market through this algorithm perspective. And it's also the most important because it's time, then price. It's not price first and then time. No, it's time, then price. We're only looking at the markets at the right times because when the right times are present, we can anticipate what the next delivery within price is going to be. With that being said, this lecture comes to an end. I hope that you found it insightful. I again apologize if the audio quality is different than usual because I'm recording this whilst being on the go. I'm recording this whilst being at the airport, so I hope everything got picked up clearly. And if not, I'm probably going to do a lot of editing afterwards, and we're going to make sure that the audio is as best as possible. I'm going to discuss the topics of delivery profiles and SMT way more in depth in the future, and I'm also going to drop further hints when it comes to timing the market within very specific intervals. But that will all come later within this model series. Thank you for watching this lecture all the way to the end, and I want to wish you good luck in your studies. Be safe.